Hey everyone! When you start digging into investing, you hear all these terms thrown around, right? Large cap, mid cap, small cap. It can honestly feel like a totally different language. But what if I told you that getting a handle on these three simple terms is one of the biggest keys to a smarter investment strategy?
Well, that's exactly what we're going to do today.
We're going to pull back the curtain and demystify this whole market cap thing.
So yeah, you see these words everywhere, and it is so easy to just nod along and pretend you know what's up. But don't worry, we're going to clear all that confusion up right now. By the time we're done here, you won't just know what they mean. You'll know exactly how to think about them for your own portfolio.
All right, so what's the big secret behind these fancy-sounding categories? It's actually incredibly simple. It all just boils down to one thing: company size. And in the world of finance, the way we measure a company's size is called its market capitalization, or just market cap for short.
Think of market cap like a company's total price tag. If you had enough money to buy every single one of its shares on the stock market, the market cap is what you'd pay. It's really the ultimate measure of how big and influential a company is. And the math to figure it out, it's about as simple as it gets. You just take the price of one share and multiply it by the total number of shares that exist. That's it. That one little calculation gives you the company's total market value, its price tag. Okay, so based on that market cap value, the Indian stock market has a pretty straightforward system. The 100 biggest companies, those are your large caps. The next group, ranked from 101 all the way to 250, those are the mid caps. And you guessed it, every company from 251 on down falls into the small cap bucket.
So now that we've got that basic idea down, let's get to the interesting part. It's time to meet the actual players on the field, the big guys, the ones that are growing, and the bold ones with huge potential. Let's break down what each of these fun categories really means for you and your money.
First up, we've got the large caps. Think of these as the giants, the big, established household names. These funds invest in companies that are leaders in their fields, They're known for stable, predictable earnings, which means they tend to be less of a roller coaster ride, lower volatility, and generally lower risk. They're the solid foundation of a portfolio.
All right, next in line are the mid caps. I like to think of these as companies in their growth spurt. They're not giants yet, but they're expanding and really hitting their stride. Now, they offer way more growth potential than the large caps, but of course, with that comes a bit more risk. They're that sweet spot, that balance between risk and reward.
And last but definitely not least, we have the small caps. These are the exciting ones, the up-and-comers, the startups, the potential game changers of tomorrow. The growth potential here can be absolutely massive because they have so much room to grow. But, and this is a big but, so is the risk. It's the definition of high risk, high reward.
Okay, let's shift gears and talk about the three most important words in all of investing: risk, return, and time. Seriously, understanding how these three things play together is the real secret to building an investment plan that actually works for you.
It is so easy to look at the potential of small caps and get all excited about those huge returns, but not so fast. You always have to remember that those amazing potential returns come with a price, and that price is higher risk, a lot more volatility, and you're going to need a whole lot more patience to ride out the bumps in the road.
If you look at performance over the long haul, a pretty clear trend emerges. Large caps have historically delivered returns somewhere in the 10 to 12% range. Mid caps, a little more, maybe 12 to 15%. And small caps, if you're willing to stomach the risk, have the potential to go 15% or even higher. But, and I cannot stress this enough, these numbers are not guaranteed. They completely depend on how the market is doing.
This table, right here, really sums it all up. For large caps, with their more moderate returns and lower risk, you're looking at an investment horizon of maybe 3 to 5 years. For mid caps, where there's higher potential, you really should be ready to stay invested for 5 to 7 years. And for the highest risk, highest return small caps, you need to be thinking 7 years or even longer to give them time to work through all that volatility.
Okay, we've gone through all the theory, which is great, but let's talk about the real world for a second, because knowing what not to do is sometimes just as important as knowing what you should do. So let's look at 4 of the most common mistakes investors make so you can steer clear of them.
Let's break these down, because they're important. First, just chasing after those huge returns by piling into small caps without respecting the risk, that's a recipe for sleepless nights. Second, panic selling. This is the classic mistake. The market dips, you get scared, you sell, and you lock in your losses. Third, mismatching your timeline. Putting money you're going to need in 2 or 3 years into a high-risk small-cap fund is just asking for trouble. And finally, putting all your eggs in one basket. No diversification. That leaves you way too exposed if one part of the market has a bad run.
So how do you actually avoid those traps? Well, the answer is to build a smart, balanced portfolio, one that's designed specifically for your goals and for how much risk you're comfortable with. It's about building a strategy, not just picking stocks.
You see, the real key to a great portfolio isn't about finding that one winner. It's about building a winning team. Each of these categories has a specific job to do. Your large caps are the steady, reliable foundation. Your mid caps add that awesome layer of growth. And then a little sprinkle of small caps can give you that extra long-term performance boost. It's all about how they work together.
Look, if you only remember one thing from our entire chat today, please let it be this. Smart investing is not about chasing the biggest, flashiest returns. It's about making choices that actually line up with your personal comfort level with risk and your long-term goals.
And that really brings us to the final question, and this one's for you to think about. Take an honest look at your own investments. Is your portfolio truly balanced in a way that's set up to help you reach your goals over the long haul? It's a really important question to ask yourself.
And of course, before we wrap up, I have to share the standard disclaimer. This conversation has been for educational purposes only. All mutual fund investments are subject to market risks, so please be sure to consult with a qualified professional before you make any investment decisions.